Welcome to the Lance Roberts Podcast right here at Real Investment Advice. And today, of course, is Technically Speaking Tuesday. And I wanted to talk about something in particular. I've gotten a lot of questions lately about, are we going into a new bear market? Is this the bear market? We've had a lot of correction over the course of the last month or so. Certainly not surprising that we're getting a lot of questions about, well, is this the beginning of the bear market? Well, I wanted to go through exactly what is a bear market or a bull market. The Wall Street comes out with all kinds of, kind of rules of thumb. If you have a 10% decline in the market, well, that's just a correction. A 20% decline in the market, well, that's a bear market. Ironically, there's not anything that's a rule of thumb for a bull market. Simply just prices go up. Oh, it's a bull market. So it's interesting that as we talk about this, there's no real guide to what actually structures a bear market. So I wanted to go through a couple of things today to kind of line out how we look at it and what we think actually determines a bull market from a bear market. Let's go back to 2000. At the turn of the century here's the S&P 500. Of course, you have the two recessionary periods, which, not surprisingly, during a recession within the economy, that's when you see the biggest declines in markets. In fact, during recessions, historically, stocks lose about 33% on average. Of course, both of these declines were roughly 50%, but the point is still the same. Economic slowdowns, of course, are when markets reprice valuations and earnings. But looking at a market like this, it's very easy to start telling what was a bear market and a bull market. Obviously, 2001 and 2 was a bear market, followed by a bull market from 2003 to 2007. Of course, the financial crisis, the bear market in 2008. And of course, we've had this decade-long bull market running really since 2009 because of the Federal Reserve, quantitative easing, a whole variety of issues. But nonetheless, looking in hindsight, bear markets or bull markets are very easy to pick out. Of course, so it should be pretty easy to simply navigate this and say, well, I want to be in the market during the bull markets. I want to be out during bear markets. And by looking at this, it should be pretty easy to do. Yet this is the one thing that investors have the biggest problem with, which is actually determining when a bear market is starting. By the time most people figure out they're in a bear market, the market's already down 30 or 40%. And well, it's too late at that point to do anything about it. But of course, nobody told them that a bear market was starting. And so they were told to buy all the way down until they finally got to the bottom, panicked, and sold out. So looking at this a little bit differently, what drives bull markets and bear markets historically is simply valuations. This is the chart of the S&P 500, inflation adjusted, going all the way back to 1871. So this is using Robert Shiller's data. And what you notice here is that markets go through regular cycles. And of course, these cycles, you have a bull market cycle in the first half, you have a bear market cycle in the second half. Of course, prices rise, they fall. And of course, this is the repricing of valuations. And if we look back in history, we can see that valuations are the driver long-term of bull markets versus bear markets. The problem again, though, is, and as we've talked about in the past, valuations are a very, very poor indicator to use to try to manage your money. If you say, well, you should be out of the market when valuations are above 23 times earnings. Well, that actually works over time, but the problem is you're going to be out of the markets for long, long periods of time because overvaluation can exist for a very long period of time, just like undervaluations can as well. So we need something a little bit more proactive about managing these turns in the markets. And we understand, though, that with bull markets and bear markets, what stocks are doing is repricing either overvaluation or undervaluation. But we can look at this in terms of looking at this from a price perspective. So here's our S&P 500 again, going back to 2000. Our bull markets and bear markets are labeled. But the question becomes, what actually denoted the turn? What did the market do in particular that denoted that the bull market was ending and a bear market was beginning? Well, one thing we can look here is at the 75-week moving average. Now, this is 75 weeks, so 52 weeks in a year. This is about a year and a half of data. And of course, all we're simply looking at here is when did the market look at the 75-week moving average. So if you look here during this recent advance in 2009 and to present, or back here in 2003, 2004, the markets were trading above this 75-week moving average. In fact, that 75-week moving average was a pretty good indication of the trend of prices. Now, here's the key word. Bull markets and bear markets. What is that? It's simply the trend of price over time. It's not a 10% correction. It's not a 20% decline. It's simply, are prices moving up or are prices moving down on average? And that is the trend of the market. And this is what defines a bull market or a bear market. It is simply the trend of the price. The 75-week moving average here, and again, this is an arbitrary index. I just picked one just to show you that prices do trend over time. And during market advances, prices are trending higher, and they tend to trend along the upside on the top of those longer-term moving averages. Same thing during a bear market. Markets tend to trade below that moving average. In other words, the price is trending lower, and they tend to price and trade below that moving average over time. Now, during the 2009 through 2010 advance, there were a couple of periods where the market actually violated that 75-week moving average and would have suggested at that time that markets were becoming much more bearish. In 2011, we were dealing with the debt ceiling debate, potential default on the U.S. debt. We were downgraded by the S&P that we were going to default on our debt. And of course, that was when Ben Bernanke launched QE2, brought a lot of liquidity into the markets, and the markets rallied from there. QE3 came in because of the threat of the fiscal cliff that kept markets elevated. But then in 2015, 2016, as the Federal Reserve was beginning to raise interest rates, talking about reducing their balance sheet, we flipped over the quantitative easing liquidity baton to the ECB and the Bank of England, came in with lots of liquidity, and stopped what was potentially the beginning of a bear market. And the market has continued to rally from that point. Today, we have once again violated that 75-week moving average, and we'll see what happens here. But again, early indication that maybe the markets are now beginning to fade from that bullish trend to a bearish trend. What will need to happen over the course of the next few months is this market consistently trade below that 75-week moving average. If that occurs, we're going to actually see more of the type of action that is denoted by a bear market historically. Another way to look at this is simply looking at the deviation of the price of the S&P 500 above or below that 75-week moving average. And again, what you see here is that when markets have traded above 200 points above that 75-week moving average, that has potentially been areas where the market begins a correction process. We have been above that ever since the end of last year. We're now correcting that process, and now, as I said, for the third time in the last decade, the markets are now trading below that 75-week moving average. So are we starting a bear market now, today? Maybe. There's some early indications that that is possible. One thing that has stopped these corrections previously was the Federal Reserve. We don't have central banks coming in to save the markets. We still have the Fed raising interest rates. We have European and global central banks beginning to reduce risk. We're seeing global economic weakness starting to rise. And with interest rates going up, we're seeing an impact to things like the housing market, auto loans, etc. So again, there are some things here that certainly contribute to the idea that we could be closer to the beginning of a bear market or not. But the thing to watch here is, and again, is to see if the price of the market begins to trade below and change the trend of this moving average from moving up to actually moving down. So whether or not that this is the beginning of a bear market, we'll find out, but we'll keep you updated as always. So simply read our blog post, watch our daily videos on our YouTube channel. Simply subscribe at YouTube, The Lance Roberts Show, or get them all on our website at lancerobertsshow.com or realinvestmentadvice.com, and we'll see you next time.